Hello people, a very good morning to all of you. So guys, today we are going to start a brand new topic, which is sale of goods on approval or return basis. So before I get into discussing the concept of this chapter, let's quickly have a glance that from our board examinations point of view, not board examination, for CA foundation examination point of view, what weightage of marks does this chapter carry? Now guys, in May 2018 attempt, if you see this chapter, we have got it for 5 marks. The questions from this chapter, we got it for 5 marks. Again, if you see in November 2018, we had this, question coming from this chapter for 5 marks. May 2019, we did not have any questions. November 2019, again, we had a question for 5 mark. December 20, they missed it. Jan 21, 5 mark. July 21, 5 mark. December 21, they did not ask. June 22, the latest paper, which is just gone by, again for 5 marks. So let's quickly have a glance. So guys, in May 2018, if you see, in question number 2C, so you had an option between sale of goods on return approval basis versus account current. So 5 mark, there's an internal choice. November 2018, again, there is an internal choice for account current and sale of goods on return on approval basis. And then in May 2019, you do not have any questions coming from this particular chapter. In November 19, you had a independent question on this chapter. Question 3B, independent question for 5 marks. November 2020, which I would say more precise, December 2020, again, you had a question. No, there's no questions, no question. In Jan 21, question number 3C, there was an internal choice between this chapter and average due date. And in July 2021, guys, you had an independent question 3D coming from this particular chapter. And then December 21, you had no questions coming from this chapter. And June 22, guys, you had an independent question, again 3B for 5 marks. So if you ask me, guys, account current, average due date, this chapter and consignment together will come for nearly about. So here you can expect a 10 mark question, 10, 20 marks. So basically these 3 chapters, you will get 10 mark question. Account current can be asked combined with ADD. ADD can be combined and asked with SOGRA. Like that, this will come for 5 marks and consignment individual come for 5 marks. Like minimum you can expect from these 4 chapters, minimum 20 marks, right? So the weightage is understood, guys. Now let's go to the concept. Before I discuss what is this concept, let me ask you a normal question. That this is, let's suppose, seller A, who is, let's suppose, a manufacturer, or he may be a wholesaler, or he may be a retailer. So this person, this is which scenario? This is a normal business scenario. Normal business. Or I can say normal sale or a regular sale. Normal sale or a regular sale. What happens? Seller, that is Mr. A, who's either a manufacturer or a wholesaler or a retailer, is selling goods. Is selling goods to the customer. To the customer. Correct? So manufacturer will be selling the goods to wholesaler. So for manufacturer, wholesaler is customer. For the wholesaler, retailer is customer. For the retailer, the end user is the customer. You understand the cycle? No? Manufacturer will sell the goods to the wholesaler. Wholesaler will sell the goods to the retailer. Retailer will sell goods to the end user. So for manufacturer, who is the customer? Wholesaler is the customer. For wholesaler, who is the customer? Retailer. For retailer is the end consumer. So customer. Here, guys, normally if you see in any business, once the goods are sold, they don't take it back as a return. I'm talking about those businesses. I'm talking about those businesses where you once sell the goods, you cannot return the goods back. Return is not allowed. Right? So which kind of businesses are such businesses where they sell goods and they don't take the return? Can I say a manufacturer, let's suppose, who's very well established, his product is established in the market, right? He's selling the goods. He has so much demand for his product that he's not bothered of any customer who's coming and telling, sir, if I don't like this product, I would want to return. He's not willing to take those kind of customers at all because his product is so much in demand. There are so many people buying the product in the market. So for example, let's say this is a manufacturer. And let's suppose this is a wholesale customer. So wholesaler says that, sir, I want to buy your products. Let's suppose the product is Dairy Milk. Dairy Milk chocolate, all of you are aware of? Can I say this chocolate is in demand throughout the country? And on everyday basis, people consume lakhs and lakhs of chocolate. So let's suppose I'm starting a wholesale chocolate business. So definitely in my product list, I would want to have Dairy Milk. Yes or no? Why? Because there's so much demand. I don't have to do the advertisement. Because the company has done so much detailed or deep advertisement, the product is already reached to the consumer. So consumer will come and ask, Bhaiya, if there's a Dairy Milk, please give, I would want to buy. So automatically, whether I do the marketing or not, the product will keep on selling. So Dairy Milk comes with an expiry period because all the goods are perishable. All the food items are perishable. After a point, they expire. Now this wholesaler is saying that, okay, I'm buying from you, let's suppose 10 lakh pieces of Dairy Milk. At the end of the year, if the chocolates are expired, will you take it back? The manufacturer says that, no, I will not take it back. Now the wholesaler has got the option to deal with him, to contract with him, or don't do the business. Now wholesaler, will he say that since you're not returning, if you're not able to take my goods back, return, I will not buy goods from you? If he tells this kind of a statement to the manufacturer, will it affect him? The wholesaler says that, Mr. Dairy Milk, if you don't take the goods, return, I'm not going to buy your product. Like that, if wholesaler tries to threaten the manufacturer, will the manufacturer get threatened? No, because if you are not selling, somebody else is selling. And my product is so reached to the end consumer, it doesn't matter whether you take the business and do it or not do it. So here, only those kinds of businesses have no return policy where the product is superbly established in the market. Are you able to follow? So if the product is well established, then you will see the business people not accepting the return policy, which means they would not accept the goods back again. Second, the nature of the business is such that the return is not being allowed or taken. The nature of the product will be such that you cannot take the return back. Example, what can we give for this? Vegetable you take home. If you don't like, can you go and tell the vegetable shopkeepers, so I don't like this, so I'll return it back to you. So there are certain nature of products. Once you buy it, you cannot return it back. So those are those business which I called as a normal sale, where once you sell the goods, there is no return policy. There's no return policy at all. But do you feel that every category of business will fall under this category, or every type of business will fall under this category? Now, what about those products which are new in market? So let's suppose we see a scenario where this is a manufacturer. A manufacturer is launching a new product. So this manufacturer is approaching the wholesaler, telling that, boss, I've launched a new chocolate with a new brand. So please buy it from me. And I put a no return policy. That is, if the manufacturer is selling the goods once to the wholesaler will not have the option to return back. If this is being given to a new product, do you think the wholesaler will be interested in that product? Because wholesaler, first of all, is not having a confidence that being a new product, how many people will come and buy? There's no clarity. In case of Dairy Milk, you have a clarity. You have a business experience where you know that every day at least 40 to 50 chocolates of Dairy Milk is being sold. So based on your experience, you will have a confidence that I know Dairy Milk is a brand well established. I will be able to somehow sell it off. I will not have any dead stock. But when it is a new product, you cannot say so. So if a person who is launching a new product, if he goes to the wholesaler and says that I'm selling the goods to you, you buy it, and due to any reason, if the goods is not sold, I will not take the return back. If that kind of a condition, if you're putting, do you think that this person will be able to sell that product in the market? No. And if you don't give a comfort to the wholesaler, how will your product reach to the end customer? So these manufacturers, guys, apart from selling the goods on credit, they also give the option of taking the goods back on return. Because when I launch a new product, my mindset is that I want my product to reach nook and corner of the country. I want every state to have my product. I want every cities to have my product. I want every street in the cities to have the product. I want every shops in that street to have my product. And if you say the wholesaler that only if you buy the goods from me, I will sell it to you, then this wholesaler is not interested. Why? Because here when wholesaler is buying the goods from manufacturer, or if manufacturer is selling, the wholesaler has to give his capital. He has to incur a capital investment. Correct? No? Here in this case, when manufacturer of dairy milk is selling goods to the customer, customer is buying it, boss. Customer is buying it by paying his money. He knows that even though I'm paying the money as initial capital, I'll be able to sell it and recover my capital because he's got the confidence on the product, because the product is well established. But in case of a new product, what confidence you have on that product? So first of all, if you ask this wholesaler to invest the money from his pocket, invest capital and then buy it, and above that, if you don't give the return policy, then this guy will not be interested. So if wholesalers are not interested, how will it reach to the retailers? How will it reach the end customers? So there are certain business models wherein you have to give the goods on credit, plus you also have to give them a return policy option. So this is in case of a new product. When a new product is launched in the market, you have to send the goods, not sell it. You have to send the goods. So these goods will be kept in the shopkeeper of wholesaler. Wholesaler should accept it. He will accept it. Only upon the acceptance, then this goods what you have sent is converted to a sale. Because I want my product to be first reaching to the shopkeeper. If you ask the shopkeeper, give me 10 lakhs, I'll give the goods, means he'll not be interested because it's a new product. So what I will tell is, you don't pay me 10 lakh. I am coming and keeping the product in your shop. You don't give me a single rupee. Whenever you sell in future, or whenever you feel that confidence is there, you tell I'm accepting the sale. That time I'll come and collect money from you. Until then, I'm keeping the money in your showcase. So I'm keeping the product in your showcase. Are you able to follow? So what is happening when the manufacturer is dealing with the wholesaler? He's sending the goods, not selling the goods. Are you able to follow? He's sending the goods because he wants his product to reach every nook and corner of the country. So this happens in case of new product. Second, this happens in the case of I would say apparels, clothing business. Now, if I have to talk about, if you go to lifestyle showroom, all the products are there on display. What happens? You trial it. You trial. If you feel it is comfortable, after you feel that quality is good, then you buy it. Now imagine, here it is fine. Imagine for online purchase, Flipkart, Amazon. All the items that you purchase comes with the condition of returning the goods. Right? If you don't like the product, if you are dissatisfied with something, what will be the problem? You have the option to return the goods within 15 days or 30 days. Because the nature is that. Imagine if Flipkart, Amazon, all this online, whoever it is, online platform, whoever is selling the goods, if they don't give the return policy, will their business function? Because when I buy the product, if there is no return or exchange policy, what if the quality is not good? The way it has been shown in the website, if the product doesn't turn out to be that way, if size is not matching, the color contrast is different. The color when you see in reality versus what you see in the screen is different. So your expectation is different, in reality something is different. So always buyer has to be given the option to return. So in those kinds of businesses, the Flipkart or all the online the business people cannot say that goods once sold is not returnable. If that clause they put, the business cannot function. So when Flipkart is sending the goods, he does not treat that as immediate sale unless it has been confirmed by you, or if you don't confirm it, they would have given that 30 days or 15 days expiry period. So upon that expiry period only, they treat it as sale. So are you able to see a difference between normal sale and this sale? This is a normal sale. In normal sale, the moment the goods has been handed over to the customer, the possession has been given. You understand what is the meaning of possession? Possession means the person who is possessing the goods, who is handling the goods. Here, until I sell, manufacturer is having the possession of goods. The moment the goods has been handed over to the customer, possession is gone to the customer now. Possession of this customer. Once the good is sold in the normal business scenario, normal sales scenario, who has the ownership of the goods? Customer, that is the wholesaler, retailer, and the end customer will have the ownership. The moment I hand over the goods, the moment the possession is coming to the customer, the ownership also is coming. Ownership means what? If something goes wrong to that product, if something happens to that product, who is responsible? Owner is responsible. Are you able to follow? But here, in this example, guys, manufacturer is not selling the goods. Instead, manufacturer is what? He's only sending the goods. So before sending the goods, the possession was in the control of the manufacturer. Once he has sent the goods, the possession is with the wholesaler or the retailer or the customer. The possession is changing. Now here, ownership is with whom? The ownership is still with the manufacturing one, because only when the sale transaction is completed, when the contract is agreed on both the sides, only then the ownership will come to the wholesaler, retailer, and the customer. Here, since you're sending the goods, the ownership is still there with the manufacturer only. Only the possession is being transferred. Because after the goods is being sent, who is having the physical possession of the goods? The customer, the wholesaler, the retailer. Are you able to follow? So in the normal business, possession transfers, ownership transfers. Therefore, both of them become debtor creditor to each of them. Here what happens? Possession transfer, but ownership is still with manufacturer. Now, whether these both are debtor or creditor, that is something we'll get to know when I discuss this topic in detail. Now, this transaction, what is happening between these two people is called as goods sent on approval bar return basis. So when I'm sending this new product, or when I'm into the Flipkart business, when I'm sending the goods, I give them a condition that within 15 days, please accept it, please approve it. If not, you return it. Are you able to follow? So this kind of arrangement, arrangement happens to the business which is launching a new product, or this kind of business model is suitable for all the people, those who are, who are doing online businesses, online transactions, right? And third, I've seen a practical example in the case of jewelry business. So what happens is manufacturer keep on manufacturing a lot of jewelries every month. So let's suppose I am a manufacturer of a jewelry. I have manufactured jewelry worth 50 lakh rupees. Super brilliant design. Only 2 pieces, 50 lakh rupees. If I come and tell you, let's suppose you are the retailer. If I come and ask you to buy 50 lakh rupees, with what confidence will you buy? Because this is a new design. Whether people will like it or not like it, you don't know. So what I would tell here is that this 50 lakh worth of jewelry, I am going to give you for 15 days. In this 15 days, if you feel that you can identify a buyer to whom you can sell this, after that you give me approval. So 15 days, I am going to keep my goods, or I am going to send my goods to you. This happens in the wholesale jewelry business. Right? The manufacturer, what they do is the manufacturer go and keep the goods in the wholesale shop or the retail shop. 15 days time, 10 days time, 1 week time they'll give. After that, after 15 days or 1 week, they go back. Out of those jewelries, whatever is sold, that they make a note of it, they put a sale bill and return the remaining products. So there are certain inherent business where the business runs on these kind of sale models. The sale happens on these kind of basis. So it depends on the nature of business. If it is a new product launch, or if it is an online business, or if there are certain businesses where the practice is like you give the goods for some time, then after that they'll accept it or sell it and then return it back. So for these kind of people, you cannot say that strictly I'll follow only this normal business sale transaction. If you strictly only depend on this kind of sale transaction, you may not be able to do business in the market. You may not be able to do very good business in the market. That is why few businesses have these kinds of business model, and few businesses, by their nature of business, they are forced to follow this kind of concept. So this is a concept where goods is sent on approval or return basis. So once goods is sent, if you approve, it becomes sell. If you return, then I'll take it as a sales return, or I can return my goods as it is. Where the return is possible, right? Anybody's got any doubt so far? Online people comfortable?
Yes, sir.
Yes, sir.
So whatever you studied, just read this theoretically, you'll get a very good comfort. Under normal course of business. Normal course of business means what? This one. Normal sale. Under normal sale, goods sold to customer is treated as a sale immediately. The moment you give the goods to the customer, the possession is transferred, ownership is transferred. And the moment the ownership is transferred, you treat it as sale. Only when the sale has been done, the ownership has been transferred. So when goods are sold to the customer, it is treated as sale immediately when goods are sold. Under the normal course of business, goods sold to customer is treated as sale immediately when the goods are sold, which means when the goods are handed over to the customer, with corresponding revenue from such sale being recognized in the profit and loss account. The moment you hand over the goods to somebody, you will prepare a sale bill. You will put a sale entry. Automatically, the sale will be impacting my trading and P&L account. This is what the first point is trying to tell. Any difficulty? However, when a businessman wants to increase his sale or introduce a new product in the market, he usually faces hardship due to competition prevailing in the market. I gave you this example. Now, this person wants to introduce a new chocolate. So can I say there are a lot of competitors in the market? Nestle is there, so many brands, Dairy Milk, all these people are heavy competitors. So now, if this manufacturer asks the wholesaler, give me 10 lakh rupees, I'll sell my chocolates, new chocolates to you. My chocolate is superb. Once you start eating, people will come to you 10 times. Orally, I'm trying to tell how much ever I want to tell. But ultimately, you will not follow what I say, because unless until you experience that from your customer, you will not accept it. So whatever you come and say, as a wholesaler, I'll not be interested. So now, how will the manufacturer try to present this product in my shop? So this is the only option where you send the goods. You tell them, keep my goods in your shop. Give the customers. Let them taste it. Once you feel you're getting a confidence on this product, you give me the approval. So initially, these kind of businesses starts with this model. Once the product is established, they'll go to the normal business scenario. So mainly you can say startup kind of people, they follow these kind of techniques first. However, when the businessman wants to increase his sale or introduce new product in the market, he usually faces hardship due to competition prevailing in the market. To counter it, goods are sometimes sent to customer on sale or return basis. Here, goods sent on approval or return basis means goods are delivered to the customer with the option to retain or return them with a specified period. So I'll give you a time of 15 days or 1 month. Within that period, you have to accept it or return it. Generally, these transactions take place between a manufacturer or a wholesaler, or manufacturer or retailer, or a wholesaler and a retailer. Clear with this point? So whatever example I gave you, is it matching with the theory? Next, in current scenario, this practice is also prevalent in case of online sale, where the buyer is given time of few days to return the goods. If the buyer believes that the specification of the goods are different from the same mentioned on the website at the time of sale. I purchased a goods. It was mentioned that, let's suppose the size is, let's suppose I ordered for L. I got the size M. So what specifications you ordered for? You ordered for L, but you got a different specification, medium size. Will you keep it? No. So you're given an option to return. So wherever your expectations is not matching, you have option to return it back. There may be certain terms and condition to administrate the return of goods. There will be certain terms and conditions, but return has to be given. They may tell that once you wear the product or once you remove the tag, we will not take it as a return. So you can have whatever terms and conditions you have, but you cannot say that I will not take return, because if you don't take return, then your business model will not be successful. Following are the essential features of sale of goods on approval or return basis. Here what happens? There is a change in possession of the goods from one person to another person. Correct? I told before sale, the possession is with the manufacturer. When the good is sent, now the possession of the goods is with the customer. He could be manufacturer, he could be wholesaler or retailer or end customer. So possession is being changed. B, it does not involve transfer of ownership. Ownership is still retained with the manufacturer only, because he has only sent the goods. He has not sold it. The ownership changes only when the approval is given, when the sale is happening. The ownership is passed only when the buyer gives his approval or if the goods are not returned within the specified period. This point, I'll give you a clarity within some time. I'll give you a clarity within this some time. The customer does not incur any liability when the goods are merely sent to us. Now, guys, manufacturer has sent the goods to the wholesaler. Is wholesaler having any obligation or liability to pay money? The liability of the wholesaler arises only when he accepts the goods. When I did not accept, you came and kept the goods in my shop, boss. How is it my liability? So ownership is with whom? Manufacturer. If ownership is with manufacturer, the risk and the reward is with the manufacturer. If something goes wrong to the goods, if the goods is damaged, who is responsible? Manufacturer. Because there is no liability on the wholesaler. He has not taken liability. You came and kept the goods in my shop. I said no only, but you kept it. I don't know, okay, you keep it. If I'm able to sell it, I'll sell it and give you the money. So when the liability of the wholesaler arises, when he sells the goods, until then liability is not triggered. The customer does not incur any liability when the goods are merely sent to him. In case of online transaction, sometimes customers are given choice to pay on receipt of goods, that is cash on delivery. And in some cases, they are required to pay in advance. So if you want some offer, they tell that don't opt for cash on delivery, pay through debit or credit card, we'll give you 200 rupees more extra offer. So you make advance payment now, then only goods are coming. And then seller will ship the goods to the buyer. Even in case buyer has paid the advance, it retains the right of refund. Even though I made the payment and purchased a dress, I still have the right to return it and get my refund back. So this kind of business is called as goods sent on approval or return basis model. Even in case buyer has paid in advance, customer retains the right of refund if the goods are returned as per the terms and condition agreed between the buyer and the seller. Am I clear or not clear? So are you clear with the difference between normal sale and the goods sent on approval basis? In normal sale, the moment the goods has been handed over, the possession is also gone, ownership also is gone. The risk and reward is of the customer. But in case of goods sent on approval or return basis, the possession is transferred, but the ownership is still with the seller only. Are you clear? Now, if you have any doubts here, please ask me. You should have one doubt. You should have one doubt. I had a doubt. You can relate this chapter to some other chapter and tell me what is the difference between this chapter and that chapter. Yes, offline people, 2 of them got it right. Online people are waiting for responses. Now this
consignment,
chapter,
sir.
Absolutely. Now I want to understand from all of you. Now that you know what is a normal sale. Now that you know what is sale of goods on return approval basis, and consignment also you've done it. What is the difference between consignment and goods sent on sale of approval basis? Okay. Okay, you guys are near, but I'm expecting a point here. I'm expecting a specific few points here. The difference between sale of goods on return approval basis and consignment. Let's talk about possession. Who is having the possession of the goods in case of Sogram? Possession. Customer basically. For manufacturer, wholesale is customer. In consignment, who is having the possession? Normal sale. Normal sale, who is having the possession? Customer. Possession of goods means the person who is holding the goods. So once the goods is sent or sold, in case of sale of goods or return approval basis, customer has got the possession. Consignment, consignee has got the possession. In normal sale, customer has got the possession. Next, ownership. Who's got the ownership in sale of goods or return approval basis? Ownership. You're sending the goods. You're not selling the goods. So when you send the goods, who's the owner of the goods still? The seller. The seller is the owner. In case of consignment, who is the owner? Consigner. Consigner. In case of normal sale, who is the owner? Customer. Online people, any doubts in this, please?
No, sir.
No,
Any
sir.
doubts? Relationship. Relationship between the customer and the seller. In case of Sogra, what is the relationship between customer and seller?
Sir, buyer seller.
Debtor, creditor, buyer, seller. What is the relationship between consignor and consignee in the consignment transaction? What is the relationship between consignor and consignee in the consignment chapter?
A principal and agent.
Fantastic. Principal spelling? PAL or PLE? Principal agent. Principal and agent. In normal sale transaction, what is the relationship between the customer and the seller? Seller buyer, which means debtor creditor. If it is a credit transaction, debtor creditor. If it is a normal cash transaction, it is a seller buyer. So what is the difference between consignment and Sogra? In the sale of goods on return approval basis, the ownership is still with the seller. Here in consignment, the ownership is still with the seller. Seller is consignor only. Now, one more difference is that when goods are sold, the ownership is going to whom? The ownership is going from manufacturer to wholesaler, from wholesaler to retailer, and from retailer to end customer. When the goods are sold, ownership is transferred from manufacturer to wholesaler, wholesaler to retailer, retailer to customer. In case of consignment, what happens is the ownership is transferred directly from consignor to end customer. In between consignee, he never takes the ownership because he is just acting as an agent for selling the goods. In between, he'll charge commission. In sale of goods or return approval basis, manufacturer will, let's suppose charging 100 rupees to the wholesaler. So for wholesaler, this 100 rupees becomes cost price. So when wholesaler is sending goods to retailer, with the cost price 100 rupees, he'll add his margin, profit margin. With 100 rupees, he will add 20 rupees as his margin. So what is the selling price to the retailer? Wholesaler is selling to the retailer for 120 rupees. So profit margin is added, and that profit margin is belonging to whom? It is belonging to the retailer. Same way when retailer is selling to the customer, retailer 120 rupees is the cost price because he purchased 120 worth of goods from wholesaler. He will add 30 rupees and sell it for 150 rupees. Are you getting my point? But here, in case of consignment, what happens is that consignor is directly transferring the ownership from consignor to end customer. So the goods which is there with the intermediary person who is consignee, he has not got any right to add the profit margin. He is only getting the commission on the sale value. So there is no markup. Markup means what? Addition of profit. With cost, I'm adding profit now. Adding the profit to the cost price is called as markup. You will come across this word very frequently in your CA career. Markup means what? I'm marking my extra profit. So here in consignment business, you don't have the privilege to mark up. Whatever this fellow is deciding the price to be sold, consignee will sell at that price and he'll get commission on that. So the income is what? Here the income is commission income. For whom? For consignee. Whereas in the goods sent on approval or return basis, here the profit is the additional earning. Are you able to differentiate now? Because in both the cases, what happens is, guys, in both the cases, why the confusion is coming? Because Sogra also you're sending the goods, and consignment also you're sending the goods. So both are sending. So it is very obvious to have a doubt. So if both we are sending, then what is the difference between the two? So I've given you clarity on the difference. Absolutely. Any doubts here? Are you getting a feel? So normal sale is something which you have studied in your entire 11th and 12th standard. Now we are going to next level of business, where we studied what is the consignment nature of business. And today we are going to understand what is the concept of goods sent on approval or return basis. Any problem, any difficulties here, please let me know. Online people, are you comfortable with the concepts? The difference between everything?
Yes, sir.
Yes, sir.
Any doubts here? Any doubts here, please?
No, sir.
Just make a note of these points. I will incorporate all this in our scanner book and give it to you. So for revision purpose, it will be easy. Just note on this point. This is not incorporated in scanner yet. Just make a note of it. Remind me. I will incorporate. Can I go forward? Coming back to this B point. Okay, B point I need to explain. Before that, I have to go to the now here, guys, in this particular chapter, we are going to come across three scenarios. We're going to come across three scenarios. 1, 2, and 3. Sale of goods on approval or return basis. You can do accounting. There are three scenarios you'll come across. First scenarios is casual. Casual means what? I am a, let's suppose, wholesaler. In my wholesale business, 90% of the business is normal sale. What is normal sale? This. Where once I send the goods or once I sell the goods, I will not take it return. This is normal business, normal sale business. So 90% of my business is normal sale. Only up to 10% businesses on SOGRA basis. So here can I say SOGRA related transactions are very, very casual, very, very limited. So here in these kind of scenario where the nature of transaction is very, very casual means very limited, then these transaction you will treat it as a normal sale. Normal sale means what? The moment you sell a goods, what is the entry that you pass? Debtors to sale. Here also you will treat it in the same way. You will treat it as a normal sale only. But in the year end, there is certain adjustment that we are supposed to do. That adjustment we don't do it for normal sale. That's the difference between the two. So in the business where the SOGRA related transactions are very, very minimum, casual in nature, you will treat the SOGRA transactions as normal sale transaction and you will pass a sale entry. The only difference is at the year end, depending on what situation you are into, you will pass a adjustment entry. Now, in your business, if the SOGRA related transactions happening frequently means what? You're a wholesaler. Let's suppose 70% to 80% of the business, I would say, let's say 70% of the business is happening as a normal sale business. Up to 30%, the percentage what I'm giving is an approximate percentage for your knowledge purposes. There is no hard and fast rule that up to 10 means always casual. No, I'm giving you a percentage just to put the concept in your mind. So 30% of your business transaction is based on SOGRA. Now, which means, can I say, compared to 10%, 30 is a little bit more. So the frequency of SOGRA transaction is a little bit higher than casual. So if your transactions are frequent, then there's a different way in which you will do the accounting. You will not treat it as a normal sale. You will treat this in a different way. What is that way? We'll learn it in the upcoming classes. Third, numerously, you are into wholesale business. 70% of the businesses goes on SOGRA basis. 70% on SOGRA basis, 30% normal sale. Then these SOGRA related transactions, you have to deal with them in a different way. You will not treat them as casual sale. There's a different way, different kinds of books that you will prepare. Because these transactions are more now. I need to put more energy, more time to understand what is SOGRA transaction, what is normal transaction. I need to differentiate. Whereas in casual transaction, guys, 90% is normal sale. For 10% transaction, if I create separate books, separate procedures, it will be complicated. For 10%, why should I take so much headache? Well, treat it as normal sale with small adjustment at the year end. Very, very small adjustment, easy adjustment. So now the question will give you hint directly telling that the transactions are casual, frequent, or numerous. Or they'll give you a language in such a way that it will indicate that it is a casual transaction or a frequent transaction or a numerous transaction. So the question will give you a hint directly or indirectly which category it is. Depending on that, you have to solve the questions in that way. Am I clear or not? Guys, am I clear or not?
Yes, sir.
So when the business sends the goods on sale or return basis, you have to you will come across 3 different kinds of scenarios. So depending on which scenario you are into, accordingly the journal entry will be passed. Next. Now, if the goods are sent casually, when the goods are sent casually, you will get more questions from this particular category, guys. The first category is the category where you have the maximum questions. Now here what happens is there are 3 options. There are 3 possibilities. Before that, business sends goods casually. When the business is sending the goods casually, what did we agree? We will treat this as normal sale. That's what we agree. So when goods is sent, when the goods is sent, if you treat it as a normal sale, what would be the journal entry? What would be the journal entry? Let's suppose it is a credit sale. This is the financial year. This is the financial year 21-22. 15th of March 2022. Goods sent with the condition to return in 1 month if you don't like it. So I have 1 month of return period. So 1 month will end when? Please tell me this 1 month will get over when? 15th of April 22. 1 month gets over, 1 month expires here. 15/4/22, can I say it's financial year 22-23? So from 15th of March to 31st of March 22, there could be 3 different possibilities. There could be 3 different possibilities. The first possibility, acceptance. Before 31/3/22, the customer says that, or the retailer or the wholesaler says that, okay, I accept the goods. In case of acceptance, what you should do? We have to learn that. What is second possibility? Within 31st of March 22, he will say that, no, I don't want. Take your goods back. I want to return it. My goods are not as per my specifications, so please take it back. So second is what? Return or rejection. Return or rejection. So when return and rejection happens, what is the journal entry or what entry you're supposed to do? We have to learn that. Final, what happens? When the return period is not expired till 31/3/22, customer did not say yes, did not say no, because you have given him time till 15/4. Till 15/4, he has time to say yes or no. But my problem here is that in between, there is a year ending. Now what should I do? So in this scenario, what I'm supposed to do? This is what we're going to learn. Are you able to follow? There are 3 possibilities. From the date of transaction till the end of year, there could be 3 possibilities. Acceptance of goods. In that case, what should I do? Return, what should I do? If the period of return is not expired, then what should I do? You have to understand all these 3 scenarios. Online people, are you able to understand what I'm trying to tell?
Yes, sir.
Now, before we jump into the entries, we have to understand mode of giving acceptance. This you will also come across in your law. Now, I have sent the goods. I have sent the goods to the wholesaler or retailer or end customer. Now, the customer, retailer or the wholesaler has to give acceptance now. In which all ways he can give acceptance? The first way is oral acceptance. He will orally tell you, boss, I like your goods, I'm keeping the goods. Or he will call and tell you that I like the goods, I'll keep the goods. That is called as oral acceptance. Any problem in understanding this? No problem. Second is written acceptance. I'll put an email saying that, my dear friend or my dear customer, I have sent you these goods. Within 30 days, kindly send me the acceptance. You're sending an email or you're sending a letter. Opposite party says that you send me email, no, I'll also give you. Why should I call and inform you? So you give acceptance in writing, in email or in letter. That is called as return acceptance. Return acceptance. Fourth is implied acceptance. What is implied acceptance? You do something with that product, or you do some actions which will indicate that you accept it. For example, I have given you, let's suppose, a shirt, or let's suppose you have ordered a shirt online. I very clearly mentioned in the terms and conditions that you are not supposed to remove the tag. You're not supposed to break the tag. If you break the tag, we will not take it back. So the moment you break the tag, guys, it is called as implied acceptance. You're doing some act. You're doing an act in such a way that breaches the contract, where the opposite person will not take the return of goods back. This is one example. All of you know now, if you order a product, if there is a tag, if you break the tag, they don't take it back. If you cut the tag, the plastic tag, if you cut it, they don't take it back. Now, another example. Let's suppose you wanted a fridge. So you are a very close friend of mine. You said that you want to, just see how the fridge is. Okay. So you could not come to my shop due to some reason. So I am sending the goods to your house. I'm sending the fridge to your house. What are you supposed to do? You are just supposed to see the good. If you're liking it, you'll keep it or else return it back. Now, what did you do? You opened the pack, you connected, you kept all the items inside, seeing whether it is cooling or not cooling. After that, do you think if you return, I'll accept it back? So you're doing some act in such a way that it is implied. Implied means what? It is inherent acceptance. You're doing some activity which amounts to acceptance. Even though you did not tell I'm taking it, but your activities were indicating that you will keep it. Or you do something with the goods that we are not in position to take the goods back. That is called as implied acceptance. Are you able to follow? You do some activity or event with the goods, or your actions are in such a way that we will not take the goods back. It is implied that you have to accept it. Implied means what? It is inherent that you have to accept it. That is called as implied acceptance. Any difficulty in the first 3 points? Any difficulty in the first 3 points?
No, sir.
Again, you'll come across in detail in the law class. Vikram ma'am will handle. Next is lapse of time. Now, we have sold the goods on 15th of March. We have given you 1 month of time within which you have to accept or return the goods. You have to return the goods. On 15th of April, you did not return the goods. 1 day went. On 16th of April, it is lapse of time. The period is expired. And I put a condition that within 15th of April, if you don't return it back, we will assume that you have accepted. So which means that this is a case of lapse of time. So within a stipulated time, if you're not returning it back, if the time is expired, then it is deemed acceptance. Then it is deemed acceptance. Deemed acceptance means what? Compulsory acceptance. Are you able to follow? Any doubt with this? Oral acceptance, written acceptance, implied acceptance, lapse of time. These are the 4 ways of giving an acceptance. All of you noted this down? Online people? Have you noted down?
1 minute, sir.
Now, when the goods are sent casually, it is treated as a normal sale. So upon a normal sale, what will be the journal entry? Upon a normal sale, what will be the journal entry? Here we'll take debtor. Let's suppose this is a credit sale. So it will be debtor account debit to sales. This transaction is happening on, this entry you're recording on the date of transaction. What is the transaction here? You're sending the goods. That is the transaction. So on the date of sending the goods, the entry you pass is debtor to sale. Because this is a casual transaction where the SOGRA related transactions are very, very few. So you will treat it as at par with the normal sale. Now here, there is three options. The first option is when goods sent on approval are approved or accepted. The opposite party says that, okay, I'll keep the goods. When he says this, will you pass any entry? What entry will you pass? Can I say the sale entry is already passed? Will you pass again debtor to sales? If you do that, debtor is recorded twice, sale is recorded twice. It will become duplication. So here, when the goods is accepted, no entry. No entry. Correct, no? Because when the goods were sent, that time itself sale entry is passed. So on approval, what? The sale is confirmed. I don't have any transactions to pass. Am I clear or not clear? All people, am I clear or not clear? I want responses from all of you guys. Please respond.
Yes, sir.
Yes, sir.
Yes, sir.
Now, second, within 31st of March, the customer says that, no, I don't like the quality. It's not as per my specification. So I'm returning the goods. So what will be the entry? I will reverse this. So sales bar sales return account debit to debtors. Because when goods is rejected, the sale is cancelled, boss. When sale is cancelled, I need to reverse the entry. Any difficulty in understanding this? My question to all of you. Normally, when the goods are returned, it has been routed through sales account, sales return account. I told sales also here. Is it right? Or not right? In your 11th and 12th standard entire classes you've studied, that whenever the goods are returned, it should be routed to the sales return account and purchase return account. But same if you see, if a cash purchase has been returned, the cash is returned in the same ledger. We pass the reverse entry in the same cash ledger, same bank ledger, same debtor ledger, same creditor ledger. But for sale and purchase alone, we are creating a different ledger. Why? I've discussed this point already in 11th. Why do they create sales return account? Why don't they adjust the reversal within the sales account? Okay, can you be more specific? Online people, please participate.
Sir, you said like online websites like Amazon will be having like too much sales returns, sir. So when that it's like put it into a one ledger sales now, there will be lead to more confusion, sir.
Okay.
So if we like divide it sales return and sales.
11th standard.
Side, no, sir. Yeah, in 11th standard, sir.
No, you're telling this answer on by yourself, or you've seen it that in my video anywhere?
Your video, sir. You Lisa said.
Okay, then okay. So because these kind of information only I give, no. Okay, so come again with your question answer. You're very near. That's like not completed the point.
Yes, sir. I mean, Amazon will be having more sales returns, sir.
Yes.
So they'll be creating a separate ledger.
Yes.
Like everything under one ledger will lead to a confusion, sir.
Perfect. Super. Now, upon return, when you return, see when sale is happening, to increase sale, we credit it. To decrease sale, you can debit sales account also. But why do we have sales return? Now, if you are a business, in your business, return is very, 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 very less. Let's suppose, out of, let's suppose 10,000 sale transactions that you do in a year, there are hardly 10 transactions. Hardly 10 sale return transactions. This is sale transaction. This is sale return transaction. Can you see the quantity is very, very less, very, very nominal. So for this sale account separately, for this sales return account separately, why to complicate? So they say that the sales return is very nominal. Now you can adjust in the sale ledger itself. So to increase my sale, you give a credit. To decrease the sale, within the sales account itself, you give debit and finish it off. But in your business, the sales return transactions are numerous, heavy return. Then it is better to create a separate ledger called as a sales return ledger, because you have to keep a track that why people are returning the goods. Out of 10,000 sale transaction, only 10 is returned. I don't have to worry about it. Out of 10,000 sale transaction, let's suppose 5,000 transactions are sales return. Don't you think that this is a worrisome for your business? Why people are returning back? So within the sales ledger, if you record 10,000 here, sorry, this is, let's suppose, sales ledger. This is sales ledger. 10,000 transactions you are recording, credit here by debtor, and to debtor 10. What is my net sale? 99,000. Sorry, 9. This is 9,990. Correct, no? My sale is not significantly affected. But here, in this scenario where there are 10,000 sale, if that 5,000 are returned, then what is my net sale? 5,000. So this carried on net sale is only transferred to your trading and P&L account. So I will not get a clarity that did you actually sell goods worth 5,000 or you sold goods worth 10,000, if that 5,000 is returned. So as a owner or as a, let's suppose the person who's reading the financial statement, maybe I might be a bank or your investor. You know the users of the financial statement, right? In 11th standard we studied external users, internal users. So users of this financial statement read the financial statement. Now, when you don't have sales and sales written separately, how will I know that why so much sale and so much sales written? If I'm an investor, I'll be worried with this. So I should be given a clarity that out of 10,000 sales, 5,000 is returned. So that's why we have a separate ledger to track it. When you adjust within the sales ledger, if return is adjusted within the sales ledger, how much return has happened, that visibility is not given to the outside person. It's got nothing to do with principle. It's got nothing to do with principle. Or I can say it is related to disclosure principle. So here I have to disclose. So if your transaction is very significant, if it's materially significant, then you have to show the separate ledger, because this will be a part of a trial balance. If you have a separate sales return transaction, it comes in your trial balance. I can ask, why so much sales return? When you don't create a sales return separately, you adjust this 10,000 and 5,000 in the ledger. Ultimately, the user gets to only 5,000. So he will think that, okay, 5,000 sale has happened. Okay. But he does not know 10,000 sale happened and 5,000 is returned. Because if 5,000 sale transaction is returned, then I'm worried why people are returning back. Then something is wrong. So that's why they say that if the transactions are numerous, it is always advisable to have a sale return transaction separately to analyze. But if the sales return transaction is very nominal, very few, you can reverse it in the sales accounts itself. You got a clarity only about this now only. But our students have this clarity from 11th. Now, here sales or sales return account. Are you able to understand this point? So when the goods are rejected, this is what you will do. Reverse the sale transaction. And what will you do? Apart from this, guys, at the end, year end, you have to pass the adjustment entry. Now, the goods has come back to our possession. When the goods are returned, guys, when the goods are rejected, goods is coming back to our premises. So at the year end, we pass an adjustment entry for closing stock. What is that? What is the adjustment entry for closing stock? Which we studied in 11th standard again. In the adjustment of the financial statement chapter. What is the journal entry for recording the closing stock at the year end? Closing stock account debit to trading account. So without forgetting, you have to record this also. Are you clear with the steps one by one? Everybody? Hello? Online people?
Yes, sir.
Next. This is the critical scenario. You have to pay your 100% attention. Time granted for approval not lapsed. Which means, can I say, the last option, when the return period is not expired. Which means what? Till the year end, you did not get the acceptance, you did not get the rejection. So here, what do I do? The sale entry, what you recorded at the year end, touch your heart and tell me, is it a real sale for you? You have sent the goods, you've not sold it. Why did you treat it as a sale transaction? Because the transactions were very few. Why to unnecessarily create a separate complication? I treat it as sale transaction. But at the year end, the acceptance is not come. Until and unless the acceptance is not coming, you cannot treat this as your sale. Therefore, you will reverse the entry. So what will be the entry? Sales. Can I write sales return here? Can I put a sales return ledger here? No. Sale return means what? When the opposite person is returning the goods. Here, did he return the goods? No. You cannot create or you cannot record this in the sale return transaction ledger. You have to reverse this only in sales ledger. Please highlight it. Very, very important. Sales return will not come here. Please write and cut it down and make a remark. Why sales return is not coming? Because the customer did not say that I'm returning the goods. If he is not returning goods, how can I record this in my sales return ledger? So it will not come in your sale return ledger. So it is sale account debit to debtor. Debtor to sale is recorded at the invoice price or the selling price. Right? And this will be reversed at the invoice price and the selling price only. Okay, not okay. I'm waiting for online people to respond. Online people, please participate, guys. The more and more you participate, I'll get a clarity that you're with me. Invoice price is sale price. Invoice price. Invoice price means what? Cost plus profit. Yeah, I mean, slight difference is there, but basically what? This price involves my profit. So this is basically selling price, reverse in selling price. There's a slight difference between invoice price and sales price that we have discussed in consignment. Now, guys, will I stop with the first entry or should I go with the second entry? What will be the second entry? What entry will you pass? Who will record the closing stock? Will we record the closing stock or will the opposite customer will record the closing stock? Think and answer. My question goes to all the students, including online people. Who will record this stock as the closing stock? The closing stock will be with, recorded by the seller or by the buyer. Any specific reason? Yes, online people.
Seller, sir.
Seller. Okay. Any specific reason? Super. Fantastic. Online people, I want your responses. Offline got the right answer. Offline people got the right answer. Who will have the ownership? Seller or the buyer?
Seller, sir.
Any specific reason, Sanjay?
Sir, because goods,
What determines or which point will determine that who will record the goods?
Ownership, sir.
ownership, sir.
Yes. Who said that? Ownership? Ownership is right. So who is having the ownership of the goods? Seller. So seller will record the closing stock in his books of accounts. So the person who owns the good will record the stock. But my question is, what will be the journal entry for that? If you record closing stock to trading, will it be right? Closing stock account debit to trading account, will it be right? Trading account credit is right. But closing stock, is it right? Closing stock means the stock under your control, which is there in your warehouse, which is there in your godown, which is there in your factory. But is this there in your factory? Is this there in your factory? So can I say instead of closing stock, it will be inventory with customer account debit to trading account. So in my balance sheet, guys, in my balance sheet, on the asset side, closing stock means our stock. Goods in our factory, warehouse or godown. If I write inventory with customer, it means goods with customer. So as a businessman, I'm coming. As a businessman, as a user of financial statement, don't you think that this is giving me clarity? Okay, closing stock means goods is in our control, in our possession. Inventory with customer means it is our goods with customer. So aren't you getting some difference point to understand? Yes, Yash. This is what is given in textbook. Whatever is given in textbook will follow that. Anything you can write. There's no hard and fast rule that you have read only this. I have written this because this word has been followed in the textbook. Am I clear or not clear? Any problem here? People, any problem here?
No, sir.
Coming to this yellow point. What is this yellow point? Sale SOGRA does not involve transfer of ownership of goods because ownership is still with the seller. The ownership is passed only when the buyer gives his approval. When he gives his approval, or when the goods are not returned within the specified period. So when goods are not returned in the specified period, which point is this? Time granted for approval not lapsed. Hence I proved my yellow point. Any comfortability, discomfortably, please let me know. Comfortable, I say comfortable. Discomfort, I say discomfort. Online people, comfortable, not comfortable?
Comfortable, sir.
Comfortable, sir.
Very good. Now tell me how many of you are comfortable with the calculation of profit on cost, profit on sale? This was discussed in the consignment chapter as well. I give you those 4 cases. Siddhi is comfortable, Samiksha is comfortable, Arjun is comfortable. Both of you not comfortable? Why did you see? Now how will you manage this? Online? Yeah, 12th also we did. Yes, we did in 12th also. Others, anybody who's not clear with the concept on profit on cost, profit on sale, etc., etc. I'll do a quick recap. I'll do a very quick recap. We did in ratios. Case 1. Cost price is 1000. Profit on cost is 25%. Please tell me what is profit quickly. What is profit? Cost price is 1000. Profit on cost is 25%. This is related to cost. This is related to cost. When both are cost, can I multiply both and get the profit? Profit on cost, which means profit is equal to 1000 into 25 by 100, which is 250. You can multiply the cost price with the profit percentage only if the nature of both are same. Here the nature is cost, here the nature is cost. Only when the nature is same, you can multiply and get the profit. This is called as profit on cost. Profit on cost. Comfortable? So what is my sale price? Sir, cost price plus profit is equal to selling price. Sir, cost price is 1000. Profit is 250. My selling price is 1250. Case 2. Selling price. Selling price is 1250. Profit on sale is equal to 20%. I want to know what is my profit and what is my cost price. Profit, guys. Here, sale price, the relation is sale. Here, profit on sale, relation is sale. Both are related to each other. If they are related, can I multiply? So profit is equal to 1250 into 20 by 100. I told you multiplication is possible when the relation is same. If the relation is cost to cost, then they are related. Here it is sale to sale, it is related. Only then profit and this I'll multiply. So what is my profitability? 250. Cost price plus profit is equal to selling price. Cost price is X, profit is 250. Selling price is 1250. So X is equal to 1250 minus 250. So cost price is equal to 1000. Any difficulty here, please? All the Amul babies. Any difficulty here? I'm not getting any responses from Abhi, Ashwin, Chavi, Kavi,
No,
Sanjay,
sir.
Shrikant, Saraswat. Please respond.
No, sir.
Understood?
Yes, sir.
Case 3. Cost price is 1000. Profit on sale is 20%. Please calculate profit. Please calculate the selling price. So profit is equal to, can you do 1000 into 20 by 100? Can you do it? No, because here the relationship is cost. Here the relationship is sale. Both you cannot do it. You cannot multiply. You cannot multiply. This is wrong. If you multiply, it will go wrong. For you to multiply the values, you have to have the same relationship. So what will I do, guys? So to have the same relationship, I need to find profit on cost. Now, if I have profit on cost and cost price, can I multiply and get the profit? So I will use this as a base to find out profit on cost. How will I do it? Profit on sale is given. So sale is given. So assume sale is equal to 100. So if sale is equal to 100 and profit on sale is equal to 20%, if I multiply these both, can I get profit? Profit is equal to 100 into 20 by 100, which is 20 rupees. Why did we assume sale as 100? Because percentage always 100. Percentage is 100, that's why we took sale as 100. Then you'll get the proper answer. You can assume something else also as sale, but it will get more complicated. So 20 rupees is your profit, guys. Now, I need to find cost price. Sale price minus profit is cost price. Sale price is how much? 100. Profit is how much? 20. What is my cost price? I want profit on cost. I want profit on cost. Profit upon cost into 100 if you do, you will get the profit on cost percentage. What is profit? 20 rupees. Cost is 80 rupees. Into 100, you will get 25%. This procedure is called as conversion procedure. You're converting profit on sale to profit on cost by following this step. This is called as conversion method. So now you have got profit on cost 25%, guys. Now come back to the real transaction. Profit on cost is 25%, guys. Now this relation also is cost. This relation also is cost. If I multiply both, I'll get profit. So 1000 into 25 by 100 if I do, I'll get my profit as 250. Selling price is what? 1000 cost price plus profit 250 selling price. I'm not teaching you for the first time. This is a recap. That's why my pace is a little bit fast. When I taught this for very first time, I went a little bit more slow. So all those people, those who have watched my 12th classes, 11th and 12th classes, there I've repeated this point. Again, in consignment, I've repeated this point. And again, I'm repeating this point here. So you should not have any doubt in this kind of scenario. Case 3 done. Case 4. Case 4. Selling price is 1250. Profit on cost is 25%. They are telling, please calculate profit. Please calculate the cost price. Please calculate the cost price. So for me to get the profit, you will say, sir, 1250 into 25 by 100. Can you multiply? Because the relationship here is sale. Here the relationship is cost. If I multiply, it will be wrong. It will be wrong. So therefore, I need to convert this profit on cost to profit on sale. So how do I do that? What is given here? In percentage, what is given? Cost is given. So what will I assume? 100. Cost. So assume cost equal to 100. So if cost price is 100 and profit on cost is 25%. So profit is equal to what? 100 into 25 by 100. I can directly multiply. Cost I can multiply with profit on cost. 25 rupees is profit. Okay. Now what do I want? I want profit upon sale because I want profit on sale. Profit sitting on sale. Can you see profit is sitting upon sale? Into 100. Profit is how much? 25. Sale price is how much? The 100 plus 25. 100 is cost price. 25 is profit. Cost price plus profit is equal to selling price. So 125 is sale price into 100. You'll get 20%. So profit on sale is 20%. So now guys, this 1250 is what? Sale price. Sale price multiplied with profit on sale. What is profit on sale? Percentage. 20%. So this relation is sale. This relation is sale. Both I will multiply and get the profit. And the profit is 250. If profit is 250, what is my cost price? Sir, sale price minus profit is equal to cost price. From sale price 1250, if I minus my profit of 250, I'll get to know what is my cost. 1000 rupees. In all these 4 cases, if you see, my profit on cost was always 25% and my profit on sale is always 20%. It did not change and will never change. If profit on cost is 20%, on sale it will be 16.67%. If profit on cost is 25%, we did this example. Profit on cost was 25%, sale will always be 20%. So now these 4 points you can keep in your memory. For this, you can keep it in memory. If any questions other than this comes, then you have to use this technique and calculate. Because in my experience, most of the questions come from any of these 4 categories. If profit and cost is 20%, on sale it is 16.67%. If profit and cost is 25%, on sale it is 20%. If profit on cost is 33.33%, on sale always 25%. If profit on cost is 50%, on sale 33.33%. So if you look at cost side, profit on cost is always more. Profit on sale is always less. If you see profit on cost is 20, on sale is 16, less. Cost more, sale less. Cost more, sale less. 25% cost, 20% sale. So if you're getting a question from this 4 part, you don't have to waste your time. You don't have to waste your time doing the lengthy calculation. If 25% on cost means what is on sale? 20%. Like that, instantly the brain should come. Now, sometimes they will not give you the percentage. They'll give you in fraction. If profit on cost is 1/5, then on sale it is 1/6. Fraction will be opposite. Cost will be less, sale will be more. If you see here, profit on cost is 1/5. Profit on cost is 1/5. On sale is 1/6. One value will be extra. If you see profit on cost is 1/4. One value extra, 1/5. 1/3, 1/4, 1/2, 1/3. Please note this down. Please note this down. Profit on cost, when it is on percentage, what happens? When it is fraction, what happens? Profit on sale, in percentage, what happens? In fraction, what happens? This is clear. I'll go to the first question of this chapter and do it for you. Once you complete noting it down, let me know, guys. We'll go forward. Done? Guys, once you're done with this, please let me know. I'll go forward. Online people done, not done. No responses.
Done, sir.
Sanjay done. Abhi, Ashwin, Chavi, are you there?
Yes, sir.
Yes, sir.
Abhi, Shrikant, Saraswati, are you there?
Done, sir.
Excellent. Now, guys, let's do the first illustration of your study material. CE sends goods to his customer on sale or return basis. So can I say this is a question from the chapter goods sent on approval or return basis? The following transaction took place during 2019. On September 15, sent goods to customer. Sent goods to customer on sale or return basis at cost plus 33 1/3%. 33 1/3% is nothing but 1/3. 33.33. So in other words, it is 33.33%. Are you able to follow? It is cost price plus 33.33% is the markup profit. So this 1 lakh is, can I say, selling price? It is telling that this 1 lakh is cost plus 33.33%. So cost plus profit is what? Sale price, no. So this 1 lakh is sale price. Do you all agree with me? Hello, people? Online people, do you all agree with me?
Yes, sir.
In October 20, goods returned by customer. Goods returned by customer. So can I say it is this scenario? Goods rejected. So this is case B. On November 25, received letters for approval from customer. Approval means, can I say case A? Case A is approval, case B is rejection. December 31, goods with the customer awaiting for approval. Which means what? The time period is still not lapsed. So this is case C. All the three cases we have. C records sale or return transaction as an ordinary sale. As an ordinary sale. What is this line trying to indicate? Which type of question is this? Is this casual, frequent, or numerous? Casual. So this is the highlight, guys. This is the highlight. Take your highlighter and at this point. This is an indication that this is a casual transaction. You're treating as a ordinary sale. This is the indication. You are required to pass the necessary journal entries in the books of CE, assuming the accounting year closes by 31st of December. Guys, accounting year closes by 31st of December. So which financial year we're into? 1890. Janak? 1890. Arjun, which financial year we're into? 1890. Siddhi? Samiksha? 1890. Siddhi? Okay. Let me ask online people. Ashwin, Abhi, Chavi, please tell me which financial year we are into. Offline majority people except Siddhi said 1890. Abhi, financial year please.
1890, sir.
1819. Ashwin, financial year.
1890, sir.
1819. Chavi, financial year.
1819.
Kavi, financial year.
So 1819.
Sanjay, financial year.
Sir,
It's only 2019, sir.
yes, sir. 2019.
Srikanth Saraswat, financial year.
Sir, where do 2019, sir?
All my dear, stupendously fantastical performances that you have performed now. What is meant by 1819? 1819 means your year starts with April 2018, ends with March 2019. When you have 2 years, the financial year is going between 2 years. It is running between 2 calendar years. That is why we are forced to give 2 years. 1819 means what? Starting with 18, ends with 19. Here the financial year is ending on 31st of December 2019. It starts with Jan, ends with December. Jan is 19, ends with 19. So 1919 means only 119. So the financial year is 2019. This is basics, 11th people. Your seniors, no, sorry, juniors. Mentally, they are seniors. They know this. The presence of mind is very important. In CA, presence of mind is important. In CA, if you don't have the presence of mind, if you don't have, the applicability of mind, if you don't have grasping power, if your memory is very weak, then how will you manage? You cannot manage. Oh, he's dependent on 12th. He's not seen your CP. Oh, you're doing CA for the first time now. Now, guys, September 15, it is a transaction between the buyer and the seller. On September 15, do we need to record any journal entry? If yes, what? If no, means say no. Online people, what do you say? On September 15, will we record any transaction? Will we write any entry? When goods are sent, it is to be treated as ordinary sale. So on September 15, we'll treat this as ordinary sale. So what will be the entry? In 2019, September 15, trade receivable, which means debtor to sales. Here, the trade receivable is nothing but debtor plus bills receivable. Both put together is called as trade receivable. So you have come to one level up now. So you have to use polished terms. So it is trade receivables. Two sales, 1 lakh, 1 lakh. Being goods sent to customer on sale or return basis. You can write debtors, but in textbook they've given trade receivables. So we have to follow. Trade receivables means both debtor and bills receivable. He did not laugh. But everybody laughed when I said. Now, guys, please note on the proper format. Heading is very important. In the books of CE, journal entries. Date, particulars, LF, debit, rupees is very important. Credit, rupees is very important. No format, no marks. No heading, no marks. No narration, no marks. Next, what is happening, guys? On October 20, Goods returned by customer. When goods is returned, what is the journal entry? Very good. No entry. When goods is returned, no entry. Wonderful. When the goods is returned, rejected, you will reverse the sale transaction. Solve with entry. Ulta entry. Trade receivable. To return inward. Return inward is sales return. Or even you can write sales also. Nothing wrong. Both are allowed. Both are allowed. Return inward is sales return. So return inward or sales return or sales. We are reversing the sales. The nature of sale account is credit balance. To increase credit balance, we will credit. To decrease the credit balance, we have to give a debit. You can write anything. Return inward, sales return, sales, anything is correct. To trade receivable. Trade receivable is debit balance. To increase a debit balance, I need to give a debit. To decrease a debit balance, I need to give a credit. So this is increase in data. This is decrease in data. October 20, being goods returned by customer to whom goods were sent on sale or return basis. Comfortable? Online people are not getting responses. Next time, if you don't respond, I'll stop asking you.
Comfortable, sir.
Yes.
Comfortable, sir.
Number 25. Received letters for approval from customer. Approval is come. No entry. No entry. No entry. On December 31, goods with customer awaiting approval. So he did not say yes, neither he said no. Why? Because the time is still not lapsed. The time is not expired. He still has time to accept or reject goods. But I have a problem is that my financial year is ending on 31st of December. So until December, if the acceptance is not given, the transactions what I've treated as sale, I cannot have it as a sale. See, out of 1 lakh worth of goods, 3 things happened. Let me do it here. Guys, 1 lakh worth of goods you've sold. In that, 3 things happened. 40,000 worth of goods accepted. 40,000 worth of goods returned. Balance is 20. I will treat this as sale because acceptance is given. This is returned, so I've returned the sale. But this is still in question mark. So till the year end, if the confirmation is not coming, you cannot treat something as your sale. You cannot treat it as your sale. If the sale happens the next financial year, again I'll pass the sale entry. Now the question that Yesh is asking, sir, till 31st of December, no confirmation is coming. So you're returning it. Okay. Next year, if he confirms and accepts, I'll pass the sale entry because acceptance is coming next year. So it belongs the income of the next year. Acceptance is coming next year. Therefore, it is income of next year. Rejected next year, that rejection entry now only we are passing. No. See, now wait. I'm coming. Now, Siddhi is asking, sir, if the goods are rejected next year. Now, on 31st of March, the entry what you are passing is as good as rejection entry. Now, you're reversing the sale. So, next financially, when you reject, what entry will you pass? At the most, the goods only is going to come back. Who's assuming? On which date it is approved? Which date? Assumption is not the game here. Who said to assume? Assumption is that at the year end, if nothing is being given, you have to reverse the sale. That is what you have to do. You cannot take any assumptions here. You cannot make the assumption that is accepted or rejected. So at the year end, if no acceptance or no rejection is coming, you have to reverse the entry. You'll pass the journal entry, what I've taught you here, which will be doing it now. These 2 entries. There are 2 possibilities. Yes, ask sir, next year if the sale has been accepted. The next year, what I'll pass? I'll repass the sale entry. Why? Because the sale entry is rejected in the current year now. So next year, when the acceptance is coming, I'll pass the sale entry. Now, Siddhi is asking, sir, next year if it is rejected, what will I do on rejection? Because already the sale entry is reversed now. At the most, the goods has to come back. That will get reversed. I'm coming to that point. So here, now let me complete this point. Your question will get answered after that. Now, here what is happening, guys? 20,000 worth of goods is balanced. No acceptance has come. So I have to reverse. The entry. What will be the reversal entry? What will be the reversal entry?
Sales return to trade receivable.
Sales return will not come here. Sales return means the opposite customer has returned. In this October 20 wala entry, sales return was allowed because the customers returned the goods. When the goods are returned by the customer, sales return ledger ke andar you will record the entry. But here they are not returning it. So you will reverse the sales account. So sales account debit. Sales account debit to trade receivable. So I'm reversing the sale worth 20,000 and I'm reversing the debtor worth 20,000 rupees. This is the first part. Second part. Is the goods under my possession or is it with the customer? It is with the customer. I need to capture that now. It is my goods. I own it. So it will be recorded in my balance sheet on the asset side. Asset is something what? Asset is something you own it. Or asset is something what you expect to receive in future. So this 20,000 worth of goods which is with the customer, it will come back to me in future if it is returned. Or in other words, I say it is my goods. I own it. The ownership is with me. So I will record that in my book. So to record asset, what will I do? I debit asset inventory with customer. So inventory with customer on sale or return account debit. Inventory with customer account debit to trading account. Like we do the adjustment entry for closing stock. Huh? Closing stock to trading account. Like that, this will also come. But as per your accounting standard 2, which you'll be learning in the upcoming chapters, I have given the hint in the 11th and 12th also that accounting standard 2, which talks about the valuation of inventory, says that inventory is valued at cost price or market price, which is also called as NRV, net realizable value, whichever is less. The logic about this I'll be giving in detail in the accounting standard 2 chapter. Are you able to follow? So here guys, the cost price we have to find out. The market value is 20,000, correct? No? The net realizable value is the sale value. Market value means sale value. In the market, if I sell this, I can sell it for 20,000 rupees. So market value of the net realizable value is 20,000 rupees. What is the cost price? So you have to calculate the cost price. How will you calculate the cost price? Sir, from selling price, if I minus the profit, from the selling price, if I minus the profit, I'll get my cost price, correct? What is my selling price? 20,000 rupees. What is my profit? What is my profit? Profit is 33% on what? This is cost plus 33%. So profit is on cost. So 33.33% is profit on cost. And this 1 lakh or more specifically is 20,000 is the sale value. Are you able to follow? This is sale value. This is profit on cost. Can I multiply these both and get the profit? Not possible. I cannot multiply. I cannot multiply. I cannot multiply. So I need to convert profit on cost to profit on sale. If profit on cost is 33.13%, then profit on sale is 25.
25.
20.
If profit on cost is 33.33%, profit on sale always will be 25%. Do you need to sit and work out this in examination on? No. So you know what is profit on sale. You know what is on profit on sale. So you'll make a remark. If profit on cost is equal to 33.33%, therefore profit on sale is equal to 25%. You got profit on sale? You got profit on sale? Now guys, 20,000 is sale price. What is my profit? 20,000 into 25 by 100. So 20,000 is sale price. 5,000 rupees is my profit. Correct? 20,000 is sale price. Profit, 25% is profit on sale. Both are related to each other. Therefore, I can multiply and get the profitability. So 20,000 minus 15,000. Sorry, 20,000 minus 5,000. You'll get 15,000 as cost. 15,000 as cost. So cost price is how much? 15,000. Market value or the net realizable value is 20,000. In this, what is less? 15,000 is less. So inventory should be recorded at cost price or market value, whichever is less. Which part? Very simple. Inventory should be recorded as per accounting standard 2. Inventory should be recorded at the cost price or the market value, whichever is less. market value or NRV is 20,000 rupees. Do you agree with me? Because for the last transaction for which the approval is not come, that sale price is 20,000. Correct? How did I know that? See, total goods that you're selling is 1 lakh. Out of 1 lakh, the balance for which the approval is not come is 20,000 now. If this is sale price, this is also sale price. So I know what is my sale price. My cost price, I have to find out. How will I find my cost price? Very simple, sir. From my sale price, if I minus profit, I'll get my cost price. Sale price is 20,000. I need to calculate my profit. What is the information available? Information says that cost plus 33.33%. So this profit, 33.33%, is profit on sale or on cost? Because it says cost plus 33.33%. Because of this word plus, this 33.33% is related to cost. So this is profit on cost. Yash, can I multiply profit on cost into the sale value and get the profitability? No, because both are not related to each other. So I cannot do the multiplication. Therefore, I need to get profit on sale. If profit on cost is 33.33%, then profit on sale is 25%. Clear with this point? Now I got profit on sale is 25%. So this is selling price, multiply with profit on sale. If I do multiply these both, can I get the profit? So profit is 5,000. From selling price 20,000, if I minus profit 5,000, my cost price is 15,000. So come back and substitute here. My cost price is 15,000. My market value or the net realizable value, NRV, is 20,000. In this, what is less? 15,000. So we record inventory at the cost price here. You may ask a question, sir, can NRV or market value can go less than cost price? Yes. What situation? Why? I'll be discussing everything in the inventory topic. So here, inventory with customer account debit to trading account, inventory with customer account debit to trading account. So in my trading account, buy closing stock will come, which means our closing stock in our control, our position. Buy inventory with customer means inventory with the position of the customer. Same way in the balance sheet also, on the asset side, you'll have the closing stock and inventory with customer. I hope you understand why closing stock and inventory with customer is coming in both trading and P&L account and balance sheet. I've given that conceptual explanation already. It is there in my 11th standard syllabus. It is there in my 12th syllabus. Also in consignment, we have discussed. What is the significance of recording the closing stock, whether with us or with the customer, both in trading account as well as in balance sheet? Which closing stock entry? Normal closing stock entry. Normal closing stock entry will come. But here, this question is revolving around the goods sent on return operating basis. So we are discussing about that goods only. Our goods, we will anyways record it. Now, Siddhi, what Siddhi is asking question is, sir, closing stock to trading account, why don't we record? I will definitely record for the other goods, which I do normal sale. Here we're discussing exclusively upon what? Sold or return basis transaction. So I'm focusing only on this particular transaction, this particular concept. Now, Siddhi asked a question, sir, next year, if the goods are rejected, what will happen? You will reverse this entry. You will reverse this entry. What will be the reversal entry? Inventory with customer is currently in debit. To cancel, I will give credit. So invest inventory in customer, inventory with customer, I'll give a credit. And I will debit closing stock. So our stock is going up. When he's returning back, when the goods are returning back, in my godown, my factory, my stock is going up. So to increase my asset, I have to debit it. And opposite customers' stock is going down. So inventory with customer is going down. Credit. So next year, if the goods are rejected, I'll pass this entry and stop. In the next financial year, this entry will come. This entry will come in the next financial year. When the goods are returned. When the goods are actually returned. Please tell me if you have any doubts or difficulty in this particular concept. Very simple concept, guys. Very simple chapter. No complications. 5 marks, we can take it just like that. Easy question. Easy question. Being an easy concept, they will only try to twist the question in different way. If all the concepts you are clear now, you will definitely find this entire concept a cakewalk. 100% full mark scoreable question, scoreable chapter. Any difficulties here?
No, sir.
Others?
No, sir.
I'm repeating one more time. If online students you don't respond, I'll stop interacting with all of you guys. I'll only interact with students those who are responding and with the offline kids.
No, sir.
Everybody.
No, sir.
No, sir.
So we're done with one question so far. Comfortable? So we'll try and wrap up this chapter probably next 2 classes maximum. Okay. So can we sum up, guys?
Yes, sir.
Fantastic.
Yes.
So yes, people, I put an end to this particular session here with this, and we'll continue again tomorrow evening. We'll meet from 5 to 6:30 p.m. Until then, bye bye. See you. Take care.
Thank you,
Thank you, sir.